Welcome to JS Online Tuitions. Today in accounts, we'll continue looking at final accounts and we'll be looking at the balance sheet. So the balance sheet is defined as a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with the combination of the owner's equity and liabilities. So we can define the balance sheet as a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with the combination of the owner's equity and liabilities. And this balance sheet is also referred to as a statement of financial position. That means that this balance sheet can show two instances. So the first instance, if the business assets are greater than a combination of the owner's equity and liabilities, that means that the business is having a good financial position, and that means that the business can use its assets to pay back debt. Then the second instance is when the combination of the owner's equity and liabilities are greater than assets. That means that that business is having a bad financial position, and that means that the business cannot use its assets to pay back debt. So let us write down these points on the whiteboard. So I've said the balance sheet is a financial statement that shows the financial position of the business at a period of time, at a given period of time. At a given period of time by comparing the business assets with a combination of of the owner's equity and liabilities. So this is the definition. So the definition of the balance sheet is a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with a combination of the owner's equity and liabilities. And we have said that the balance sheet is also referred to as a statement of financial position. So the balance sheet is also referred to as a statement of financial position. And we have said that when the business assets are greater than a combination of the owner's equity and liabilities, that means that the business is having a good financial position, and that means that the business can use its assets to pay back debt. Then the other instance, we have said that when the combination of the owner's equity and liabilities are greater than the business assets, that means that that business is having a bad financial position, and that means that that business cannot use its asset to pay back debts. So let us write down those points. So when the business assets are greater than the combination of owner's equity and liabilities. That means that the business is having a good financial position, and meaning that it can use its assets to pay back debt. And the second instance, we have said when the combination of owner's equity and liabilities is greater than business assets, that business is having a bad financial position. So the business is having a bad financial position, and meaning that it can't use its assets to pay back debt, and meaning that it can't use assets to pay back debts. Let us now look at the accounting equation. So the balance sheet is based on the accounting equation. In the accounting equation, we have assets is equal to liabilities plus owner's equity. And this financial statement is referred to as a balance sheet because the two sides of the equation that I'm going to write down must always balance. And that means that the assets can be obtained by the business by either using two methods, so by either using liabilities or by using owner's equity. So for liabilities, we mean that assets can be obtained by borrowing money from outsiders, and for the owner's equity, we mean that the money that is invested by business owners. So let us write down these points. So I've said that the balance sheet is based on the accounting equation. So that's the first point. So the balance sheet is based on the accounting equation. And have said that the accounting equation can be written in this form. So we can say assets is equal to liabilities plus owner's equity. And I've said that this financial statement is referred to as a balance sheet because the two sides of this equation must always balance. And From this equation, we have seen that assets is equal to liabilities plus owner's equity. And that means that these assets can be obtained in two ways, either using liabilities or owner's equity. So for liabilities here, we mean the funds that are borrowed from outsiders and using those funds to purchase assets, or we can use owner's equity, and these are just funds that are invested by business owners. So this is the accounting equation. Where you have questions, please ask in the group. So we have said that the balance sheet is based on the accounting equation, and we have said that the assets is equal to liabilities plus owner's equity. And I've written this formula. So we have assets is equal to liabilities plus owner's equity. That means that we have to look at assets, we have to look at liabilities, then we have to look at owner's equity. So we're going to start with assets. So what are assets? So assets are defined as items or properties of value that the business owns, or they can be defined as these are properties that are used in business operation. And assets can be divided into two parts. So we have fixed assets and current assets, but assets can also be categorized into intangible assets. And we're going to look at fixed assets and current assets. So for the fixed assets, these are type of assets that are used in a business for a long period of time, and their lifespan is more than 1 year. Giving some of the examples of fixed assets, we have plant and machinery, we have land, we have building, we have motor vehicle, we also have furniture. Then let us look at the current assets. So for the current assets, these are type of assets that are used in a business for a short period of time, and their lifespan is less than 1 year. These types of assets usually change form, or they can be easily be converted into cash. Examples of current assets, we are having cash in hand, cash at bank, we are having debtors, we're also having stock. And we are going to see for stock we can have raw materials, we can have work in progress, we can have unsold finished goods. We're going to look at those into details. Then I've also said that the assets can be categorized into intangible assets. So for the intangible assets, these are non-physical properties of value that the business owns. That means that this business can sell these non-physical possession in order for them to make profit. And examples of intangible assets, we have goodwill, we have patents or copyrights. We also have brand names of companies and businesses. So let us write down these notes. So I've said the assets. So for the assets, these are items or properties of value. Properties of value that the business owns. These can also be defined as properties that are used in operation of the business. And I've said that for the assets, this can be divided. This can be divided into current assets and fixed assets. But we must also take note that these can also be grouped. This can also be grouped into intangible assets. So we'll start by looking at the current assets. So start with the current assets. So for the current assets, these are assets that are used in a business for a short period of time. So types of assets that are used in a business for a short period of time. Then we must also take note that this type of assets usually change form in the operation of the business. So these, they change form during business operation. And these can easily be changed into cash. They can be easily be converted into cash. And let us look at some of the examples. So the first example there, we have cash in hand. So cash in hand, that means that the business money at the business premises. So that's cash in hand. That just refers to the business money at the business premises. Then the other example, we have cash at bank. So this is the business money on the bank account. So the business money on the bank account. Then we also have debtors. So this is the amount of money that is the credit customers owe us. So this is the money that credit customers owes the business or us. Then we also have stock. And you must take note that when you are writing down the balance sheet, I know you're going to be given the trial balance, and in the trial balance, that's where you're going to use that information that you're going to record in the balance sheet. But you have to take note that there will be stock that's going to be shown in the trial balance. So that stock is not recorded under the current assets, but you get the stock that is outside the trial balance, and that stock is the closing stock. Then for the closing stock, or the stock that you're having, this can be raw materials. So you have to get raw materials of closing stock. This can also be work in progress. So we have work in progress. Or unfinished goods. Or we can have unsold finished goods. So unsold finished goods. So these are the types of assets. So I've said Examples of assets, we have cash in hand, cash at bank, debtors, and stock. And if you have been told to classify these according to their liquidity, or which one is the most liquid here is cash in hand. That's the most liquid, then followed by cash at bank, then followed by debtors. But most of the people might be having the debate like which one is more liquid between debtors and stock. So debtors is more liquid because the goods have already been sold, and the only issue there is just receiving payment, and the payment can be made when it's demanded from the debtors. So from the debtors are more liquid than stock. But considering stock here meaning that the goods have not yet been sold. So the business is not sure whether those goods are going to be sold or not. So that means that stock is less liquid than debtors. But classifying these in terms of which one is most liquid, so we have cash in hand, cash at bank, we have debtors, and we have stock. Where you have questions, please ask in the group. So let us now look at fixed assets. So fixed assets, these are type of assets that are used in a business for a long period of time. So these are assets that are used in the business for a long period of time. And we can say their lifespan is more than 1 year. Let us look at some of the examples of fixed assets. So examples of fixed assets. So we are having plant and machinery. So plant and machinery. Then the other example, we have land. Then we are also having building. Then we are also having motor vehicle. So motor vehicle. Then we can also have furniture. So these are examples of fixed assets. So I've said plant and machinery, land, building, motor vehicle, furniture. Let us now look at liabilities. So for the liabilities, we know that when the business is starting, that means that it will need funds. And the funds that are going to be needed by the business that are going to be used in purchasing fixed assets. And some of the fixed assets have said we are having plant and machinery, land, buildings, motor vehicle, and furniture. So the business needs these funds in order to purchase this, but the business also needs the funds in order to finance working capital. And working capital is the amount of money that is used in the day-to-day operation of the business. And we said that from the accounting equation, we are having, from our accounting equation, we said we are having liabilities plus owner's equity. That's what we said. That means that when the business is starting, it will need funds, and these funds can either be obtained from the owner's equity or liabilities. And I've said that the business will need the funds in order to purchase the fixed assets. And some of the fixed assets I've said land, buildings, machinery, and plant. Then we also have furniture, but it also need the money in order to finance the working capital. In the working capital, that's the funds that are needed for the day-to-day operation of the business. So if the funds that are invested by the business owners are not enough to finance these things that I've mentioned, it's supposed to borrow some of the money from outsiders. So the process of borrowing money from outsiders, that's liabilities. So that's what's referred to as liabilities. And to define liabilities, liabilities are defined as debts or financial obligations that have to be paid back to outsiders. And these outsiders are not business owners. So that's the definition of liabilities. And liabilities can be divided into two parts. So we have current liabilities, and we also have long-term liabilities. So what do we mean when we say current liabilities? So current liabilities are defined as debts or financial obligations that have to be paid in a short period of time. And examples of current liabilities, we're having creditors and bank overdraft. Then looking at long-term liabilities. Long-term liabilities, these are debts or financial obligations that have to be paid for a long period of time. And examples of long-term liabilities, we are having a bank loan and debentures. So let us write down these notes. So I've said when the business is starting, it will need the funds, and those funds can either be obtained from owner's equity and liabilities. So when the business starts, to operate, if it starts by using the owner's equity, and if the owner's equity is not enough, it's going to be opted to get the funds from outsiders. And the option of getting the funds from outsiders, that's referred to as liabilities. So we can say liabilities are financial obligations that have to be paid, back to the outsiders. And the outsiders, in this case, that means that these are not business owners. They're not involved in the business that you do. And I've said that the liabilities can be grouped into current liabilities and long-term liabilities. So liabilities can be grouped into current liabilities and long-term liabilities. So we'll start with the current liabilities. So the current liabilities. So the current liabilities, this is debts that has to be paid in a short period of time. So debt that has to be paid in a short period of time. And examples here, I've said we're having creditors and we are also having bank overdraft. So creditors here, this is just the amount of money that is owed to the suppliers. And for the bank overdraft is a situation where the business is able to withdraw more money than its bank balance. Then let us look at long-term liabilities. So these are debts or financial obligations that have to be paid in a long period of time. So this is debt that has to be paid in a long period of time. And let us look at some of the examples. Here we are having bank loan. Then we are also having debenture. So that's what we can talk about on current liabilities and on long-term liabilities and on fixed assets. Where you have questions, please ask in the group. So let us now look at owner's equity. So owner's equity is equal to assets minus liabilities, and I've already written down this formula. So we have owner's equity is equals to assets minus liabilities, and we're going to look at types of capital. So the first type of capital there that we are having capital owned or equity capital. And this type of capital can be found by, but before we look at the formula, this capital owned or equity capital is also referred to as owner's equity. So using the formula, we can say owner's equity is equal to assets minus liabilities. So this is the formula. But in a case where you have initial capital, then you are also having new capital, then you are also having net profit, and we know what net profit is. Then we are also having drawings. And drawings, we know that this is the amount of money that is withdrawn for personal use. So in a case where you have initial capital, then you have new capital, then you have net profit and drawings, our formula is going to change. So we are going to say owner's equity is equal to, so we are going to first add the initial capital plus the new capital. Then when we find that total, we're going to say plus the net profit. And this net profit, that means that for this net profit, it is not distributed into dividend. So that means that it is brought back into the business. So we can say add net profit. Then when you find that total minus drawings, and we have said that drawings is the amount of money that is used for personal use, so minus drawings. So that's can be the formula. So that's all about capital owned or equity capital. Let us look at the second type of capital. In the second type of capital, we have borrowed capital or loan capital. So borrowed capital or loan capital, this is the type of capital that is obtained from long-term liabilities. So we can say borrowed capital is equal to long-term liabilities. And for the long-term liabilities, we gave examples. We have a bank loan and debenture. So here for the borrowed capital, so borrowed capital is obtained from long-term liabilities. So borrowed capital is obtained from long-term liabilities, and that means that it can be obtained from bank loan and debenture. So can be obtained from bank loan and debenture. And giving the formula there for borrowed capital, we can say the borrowed capital is equal to long-term liabilities. Let us look at another form of capital. The other form of capital that we are having is working capital. So working capital are the funds that are needed in the day-to-day operation of the business. And working capital is equal to current assets minus current liabilities. That's the formula. So here we can say we are also having working capital. So working capital, these are funds that are used in the day-to-day operation of the business. So we can say funds or amount of money that is needed for the day-to-day operation of the business. So funds needed in day-to-day operation of the business. And this can be found by, so we can say working capital is equal to, so we can say is equal to current assets minus current liabilities. So working capital is equal to current assets minus current liabilities. We can also say that when the current assets are greater than the current liabilities, that means that we can find net current assets. So in this situation, we're going to find net current assets. But if this is the opposite, where the current assets are less than the current liabilities, that means that we're going to have net current liabilities. So where the current assets are less than the current liabilities, that means that we're going to have net current liabilities. So in this instance, we're going to have net current liabilities. So let us now look at the other type of capital, which is fixed capital. So fixed capital is the amount of money that is used to purchase fixed assets. So this is the amount of money that is used to purchase, fixed assets. And examples of fixed assets, we having plant and machinery, we are having building, we are having land, we are having motor vehicle, we are also having furniture. So that's a fixed capital. And for the fixed capital there, you can say fixed capital is equal to fixed assets. Fixed assets. So that's the formula. Let us now look at liquid capital. So for the liquid capital, these are assets that can easily change form. So liquid capital, these are just assets that can easily change form. That's liquid capital. So assets that can easily change form, or can be defined as assets that can be converted into cash quickly. So assets that can be converted into cash quickly. And giving examples of liquid capital, there we are going to have cash in hand, which is more liquid, then followed by cash at bank. Cash at bank. Then also having debtors. We're also having stock. Although stock is the least liquid amongst these current assets. Then let us now look at the other form of capital. The other form of capital, we are having capital employed. So capital employed. And the formula for finding capital employed there, let's look at the formula for finding capital employed. The formula that we use for finding capital employed, we say fixed assets plus working capital. And we have said that the formula for finding working capital, we have said that current assets minus current liabilities. So the formula that we use when finding capital employed, we say fixed assets plus working capital, and we know that working capital is equal to current assets minus current liabilities. And from our discussion, we said that for the accounting equation, we said assets is equal to liabilities plus owner's equity. And we have discussed about the assets, we have discussed about the liabilities, and we have discussed about owner's equity. So where you have questions, please ask in the group. So if you want to join our online tuitions, they go at 100 kwacha per subject, and we provide the following subjects: physics, mathematics, chemistry, biology, accounts, and commerce. For more information, you can call me or text me on WhatsApp on this number, 0973023620. You can also text me on Telegram on the same number. You can also call me on this number, which is 0964286913. So let us continue looking at the balance sheet. Let us now look at the formatting of the balance sheet. So I've already drawn this formatting. So we have the title there. So the first thing that we're going to do, we're going to say fixed assets. Then we're going to have our cost here. Then we're going to have depreciation, and we're going to have net book value. So for the fixed assets, we know we can have plant and machinery, so we can have an amount here. And for this column cost here, we only put in cost when we have depreciation. But in a case where we don't have depreciation, the cost of the plant and machinery is going to be placed direct on the net book value. And we know that depreciation, we can either have reducing balance or straight line method. So plant and machinery, then we can also have fixtures and fittings. So fixtures and fittings. So we can put our fixtures and fittings here. Then we can also have land. We can put our land here. So these are just examples of fixed assets. So for example, if we have these three fixed assets, we're going to find our total here. So we are going to add plant and machinery plus fixtures and fittings plus land there. Then we're going to have total fixed assets. So we can say total fixed assets. So this is the amount of our total fixed assets. Then we can say current assets. And for current assets here, we know we have stock. And stock, we mean closing stock. So we're going to put our stock here. Then we also have debtors. So for debtors, we put here. Then we have bank, which is cash at bank. Then we also have cash in hand. So this is going to be referred to as cash. So we can find the total there, and the total is going to be referred to as total current assets. Going to put our total here. Then we can say less current liabilities. In liabilities, we can have creditors. Creditors also referred to as account payable. So we're going to have creditors here. Then we are going to have bank overdraft. Bank overdraft recorded here. So you can find the total of this. And that means that we're going to have total current liabilities. So we're going to have total current liabilities. So this is going to be our total current liabilities. And here we can find the difference between the current assets and the current liabilities to get our working capital. So to find our working capital, we'll say the total current assets minus the total current liabilities, and we're going to have our working capital, and we'll put our working capital here. And that means that we can add our total fixed assets plus working capital to get capital employed. So we are going to add total fixed assets plus working capital, and we're going to have capital employed. So this is going to be our first answer, and we're going to say financed by. So financed by, then we're going to put our capital. So capital, we're going to put it here. Then we're going to say add net profit. So we can add net profit here. So we're going to say capital plus our net profit. We're going to find this figure. Then we can say less drawings. In drawings, we know this is the amount of money that is spent on personal use. So here we can say less drawings. So when we find the difference there, we're going to find net capital or capital owned then we can say add long-term liabilities, and these long-term liabilities we can have bank loan, So bank loan here. Then you can also have debenture. Debenture. So you can have debenture there. So we can find the total between bank loan and debenture, and we can say total borrowed capital or total long-term liabilities. So we're going to put our total borrowed capital there. So that means that we can add our net capital plus total borrowed capital there. We're going to have this figure. And you must take note that capital employed, which is this figure, must be equal to the last figure. And that means that your balance sheet has balanced, and that will prove that your calculations are correct. Where you have questions, please ask in the group. So let us now try to look at these examples. So we have the first example, and you can read the question on the screen. From the trial balance of Makoko extracted after 1 year's trading, prepare A, income statement, B, balance sheet. So we have Makoko's trial balance for the month of 31st December 2006. So we are having sales amounting to 190,576. Then we have purchases amounting to 119,834. Then we have salaries amounting to 56,527. We have motor expenses amounting to 2,416. We have rent amounting to 1,894. We have insurance amounting to 372. We have general expenses amounting to 85. We have premises amounting to 95,420. We have motor vehicles amounting to 16,594. We have accounts receivable amounting to 26,740. Then we have accounts payable amounting to 16,524. We have cash at bank amounting to 16,519. We have cash in hand amounting to 342. We have drawings amounting to 8,425. We have capital amounting to 138,066. And our totals on the debit side and on the credit side is 345,166. Then we have been given inventory. Inventory at 31st December 2006 was 12,408. And our first question A, we have been told to prepare the income statement. So for the income statement, I've already written the title. So the title is going to read Makoko's Trading Profit and Loss Account for the year ended 31st December 2006. So we're going to start by looking at the trading account. And for the trading account, we start with sales. So the sales figure there, it's 190,576. But before we record sales, we have to look at the question and we have to identify if we have sales retains or returns inwards. So we don't have retains inwards. That means that we're going to say our sales, we're going to put them at the end there since we don't have retains inwards. And the next thing that we're supposed to record, since we don't have retains inwards, we're supposed to record opening stock. So in the question, as you can see, we don't have opening stock. That means that we're going to record purchases. So we're going to say purchases. And before we record purchases, we also have to see in the question if we have retains outwards or purchases retains. So we don't have purchases retains. We also have to identify if we have any carriage inwards or wages. So we don't have that with the amount of 119,832. Then we can say less closing stock. And our closing stock figure, we are having 12,408. So we're going to find the difference. So we're going to say 119,832 minus 12,408. The answer there is going to be 107,424. So that's going to be our answer, and this is going to be cost of sales. That means that we can find our gross profit or loss, and considering here the sales is greater than cost of sales, that means that we're going to have gross profit. And to find our gross profit there, we're going to say 190,576 minus 107,424, and the answer there, we're going to have 83,152. So that's going to be our gross profit. So let us look at the profit and loss account. So let us look at the items in the trial balance. So let us identify if we have any gains. So we don't have any gains. That means that we're going to skip the part of gains, but we do have expenses. And the expenses that we are having, we have salaries, we have motor expenses, we have rent, we have insurance, we also have general expenses. So we can say less expenses. And expenses here, we have salaries. So say salaries. And salaries amounting to 56,527. Then motor expenses. So motor expenses amounting to 2,416. Then we have rent amounting to 1,894. Then we have insurance amounting to 372. Then we have general expenses amounting to 85. And looking at the items that we have been given, these are the only expenses. So we can find the total. So we're going to say 56,527 plus 2,416 plus 1,894 plus 372 plus 85. We're going to have total expenses. And our total expenses there, we're going to have 61,294. That's going to be the total expenses. So we can find the difference between gross profit and total expenses. And when we find the difference there, we're going to have 21,858. And since this amount is positive, that means that this is going to be net profit. It's going to be net profit. So our net profit is going to be equal to 21,858. Let us now look at the balance sheet. So the first thing that I'm going to do when writing down the balance sheet is to put up the title. So the title there, we're going to have Makoko's balance sheet as at 31st December 2006. So that's going to be the title. And we can say cost, depreciation, net book value. Here we're going to have fixed assets, and we can put the initials for currency. So to identify our fixed assets in the question, let us identify the fixed assets. So what are we having? So the fixed assets that we are having premises and motor vehicles. So we're going to say premises. And since we don't have any depreciation, this amount is going to be recorded in the net book value column. So that's 95,420. Then we have motor vehicles. Motor vehicles amounting to 16,594. So 16,594. So we can find the total there. So we can say total fixed assets. So when we find the total there, we are going to have the answer that we're going to have is 112,014. So that's going to be our total fixed assets. Then we can say current assets. And for the current assets, let us identify the current assets that we are having in the trial balance. So for the current assets, we are having our stock. In this stock, you must record closing stock. So we're going to have stock there amounting to 12,408. Then the other current assets that we are having in the trial balance, we are having accounts receivable. So accounts receivable. So accounts receivable are also referred to as debtors. So this is amounting to 26,740. Then we are also having bank. So bank amounting to 16,519. Then we are having cash. Cash amounting to 342. So these are the current assets that we have in the trial balance. So we are going to find the total. So when we find the total there, we are going to have 56,009. So we are going to say total current assets. Then we can say less current liabilities. So less current liabilities. And the current liabilities that we are having in the question, we have account payable. So account payable. And that's the only current liability that we are having. That means that we're going to record it here direct. And that amounted to 16,524. And finding the difference there, we're going to find the working capital. So to find the working capital, we're going to say total current assets minus the current liabilities. And the answer there, we're going to have 39,000 22,485. Then we can find our capital employed. To find capital employed, we're going to add the fixed assets, total fixed assets, and working capital. So we are going to add 112,014 plus 39,485. The answer that we are having is 151,499. So this is the figure that we are having. So we can continue this side and we can say financed by. So financed by capital. So what amount of capital are we having in the question? So the amount of capital is 138,066. So having 138,066. Then we can say add net profit. In the net profit that we had calculated net profit of 21,858. So we are going to add there in the answer that we're going to have. We're going to have 159,924. And since we have drawings, we're going to say less drawings. In the amount of drawings that we are having 8,425. And we are going to find the difference there. In the difference, we're going to get net capital, which is also referred to as capital owned. In the answer that we're going to have this answer. So we're going to have 151,499. And if you look at the questions, we don't have any long-term liabilities. That means that we can end here. That means that this is going to be our answer. As you can see, this figure in the figure for the capital employed is the same. That means that our balance sheet has balanced. So that's how you prepare the balance sheet. Where you have questions, please ask in the group. So this program has been brought to you by Joswale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless.